Okay, we're doing question number 2 from chapter 15.6. It's asking us, beginning in 2008, the Federal Reserve and the U S Treasury Department responded to the financial crisis by intervening in financial markets in unprecedented ways. Briefly summarize actions of the Fed and the Treasury. And I'm going to talk about two things, and they absolutely were unprecedented. The first of which was the buying of mortgage-backed securities. I'm going to just say MBS up. The Fed spent literally trillions of dollars buying all these toxic mortgage-backed securities, which were basically worthless financial assets that were completely plaguing the books of pretty much every big financial institution in America, as well as even in other parts of the world. Because these assets were worthless, they caused a lot of banks to go bankrupt, and eventually the government was like, we have to do something, and that involved buying the mortgage-backed securities. The other one is related to this, might be a little bit broader, but it was just generally intervening to help banks. This was pretty much unprecedented in American history that the Fed would step in to directly help the banks. But they realized that after some big banks, such as Lehman Bros, went down, these financial institutions were literally the cornerstones of the American economy. And if the government didn't step in, the banks would collapse and the economy would completely collapse. So while these were, pretty unprecedented policies from the Fed and Bernanke, they proved to be incredibly effective. And, even though the recession was very bad, it could have been a lot worse had the Fed not stepped in.